The regret cost of entering too late. A behavioral finance and opportunity cost analysis. Entering an investment too late does not just reduce potential returns. It creates a psychological burden. A regret cost that influences future decisions. The financial cost is visible. The emotional cost compounds silently. 1. The financial opportunity cost. Markets often move in nonlinear bursts. A significant portion of long-term returns may come from short recovery periods, early trend acceleration, rapid sentiment shifts. When investors hesitate and enter late, they buy at elevated prices. Expected future returns shrink. Risk to reward becomes less favorable. Missing the early phase reduces the compounding runway. In compounding systems, starting point matters disproportionately. 2. Regret theory and delayed entry. Economists studying regret, including Daniel Kahneman, show that anticipated regret strongly influences decision-making. Investors often delay entry because they fear immediate loss. They want confirmation. They wait for certainty. But when prices rise without them, regret intensifies. This creates a feedback loop. Hesitation missed gains regret emotional entry at higher prices. The entry becomes reactive rather than strategic. 3. The fear, confirmation trap. Late entry usually follows initial doubt, price increase, social proof. Everyone else is in. Emotional pressure. Entry at advanced stage. By the time uncertainty feels low, valuation is often high. Psychologically, humans prefer certainty over optimal timing. Behaviorally, safety often arrives when upside is already reduced. 4. FOMO and social amplification. Fear of missing out, FOMO, amplifies late entry behavior. In environments with social media, financial news cycles, public return comparisons, investors see others winning and feel behind. This shifts motivation from long-term wealth building to short-term emotional relief. The regret of not participating becomes stronger than valuation discipline. 5. Identity and ego involvement. Entering late often damages self-image. Thought patterns include, I should have seen this. I knew it would rise. I hesitated too much. This triggers hindsight bias, also studied extensively by Daniel Kahneman, where past uncertainty appears obvious in retrospect. The emotional discomfort may push investors into overcompensation trades, larger position sizes, shorter-term speculation. Regret does not stay isolated. It influences future risk behavior. 6. The compounding time penalty. In long-term investing, early participation matters. Investors influenced by Warren Buffett often emphasize time in the market over timing the market. When entry is delayed, compounding starts later. Portfolio growth curve shifts right. Lifetime wealth trajectory compresses. The cost is not only the missed move. It is the shortened growth window. 7. When waiting is rational. Not all delayed entries are mistakes. Waiting may be rational when valuations are extreme. Risk tolerance is misaligned. Capital allocation plan requires discipline. The regret cost becomes harmful only when delay is driven by fear of short-term volatility, overanalysis paralysis, emotional hesitation without structural reasoning. 8. How to reduce regret cost. 1. Use predefined allocation rules. 2. Invest systematically, e.g., periodic contributions. 3. Accept uncertainty as permanent. 4. Avoid seeking perfect entry points. Systematic investing reduces the emotional weight of timing decisions. The core insight. Entering late feels like a missed opportunity. But the deeper cost is psychological. Increased self-doubt. Emotional overcorrection. Reduced discipline. Markets reward participation over perfection. In long-term investing, the goal is not perfect timing. The goal is consistent exposure to growth. Regret shrinks when process replaces prediction.